Hello and welcome to CFA Society New York's podcast, Compound Insights. I'm your host, Rob Rowan with CFA Society New York. Today we have a really interesting topic. We're talking about some of the perhaps unintended consequences of the trend towards outsourcing on the part of investment books at insurance companies. So today we're interviewing Bill Putsiaka. He is currently consulting, doing board work, research on application of emerging data science methods, advising, coaching some fintech companies, and he's also writing and speaking. So his past executive roles give him a lot of things to talk about on this podcast. So he was the chief investment officer and SVP of AIG Property Casualty. He was CEO of Panagora and CEO of Arkwright Mutual Insurance Company, which he managed to form FM Global. So Bill received a bachelor's from Muhlenberg College and an MBA from Carroll at Boston College. So Bill, thank you for being here. I'm really excited about talking about this.
Great to be here, Rob. Thanks for having me.
Could we start with your macro view? Because when we were prepping for this a little bit, we talked about some of the factors that could inflate the long-term liabilities for insurance investors.
Mm-hmm. Sure. So first, my general view on inflation is that it's stabilized and will persist at a higher level because of the relative insensitivity of demand, in part attributable to the extraordinary government financing and what I think is an anemic Fed policy, not a hawkish Fed policy, that is much more prone to err on the side of higher inflation than it is on job losses.
Okay.
Well, just a point of historical context on that, and then we'll get into why inflation is a bad day at work for insurers. Mm-hmm. So historical comparisons, as you know, Rob, are suspect for many reasons, but they're not irrelevant. So today's headline inflation is like 8%, 200 basis points lower than it was in 81, where it was about 10%. And the Fed funds rate today is 25 to 50 bips. And back then, the Fed funds rate was 21%.
Right. And just for point of reference, we're recording this on March 24th in case anything changes, say, next week.
So. Yeah, right. For sure. As it probably will. So for insurers, this depending on line of business, I call this a really bad day at work because these are balance sheets that are particularly susceptible to inflation. On the asset side, while regulatory regimes are different, they generally have promoted, high quality fixed income instruments, which are really exposed to a decline in real rates. In defense of the regulators, I would say that they are appropriately more concerned about near-term capital adequacy than they are about long-term capital growth. Mm-hmm. But that notwithstanding, that's where the regulations orient insurance companies on the asset side. It gets compounded, Rob, for, let's say, public companies in particular that are driven to post reported income more than like a growth in book value, which pushes them out even on a flat term structure, duration-wise, even beyond their liabilities, right, in order to respond to these other pressures. And the liabilities, in my personal opinion, are the bigger problem. As we discussed in that earlier first conversation we had, and certainly depending on the composition, inflation can drive the notional values of these liabilities much higher and faster than the interest rates at which they are discounted, mm-hmm, with the net effect being a growth in present value.
Right.
So, okay, let me get this straight. Your assets are getting crushed and your liabilities are going up. This is why I think of it as a bad day at work.
Well, and hasn't that happened historically? Hasn't it been that when there are rises in inflation, interest rates lag them significantly in past eras?
Yes, no question about it.
Okay.
I think the question is what you do about it.
Right. So what do you do about it? Private assets, maybe?
Well, we'll get to that. So I think that that on the asset side, obviously it's self-evident you want some positive beta to inflation hedging assets, despite the regulatory and accounting limitations that are somewhat of a headwind. In the absence, I would say, of some interesting repackaging by the scientists in structured finance, where you can get these exposures in a more capital efficient way. I think on on the liability side is really, I know this is an investment podcast, but I feel, compelled to mention this, is that the answer is reducing your operating leverage as a company until you price inflation into your coverage or exclude it explicitly.
Mm-hmm.
I've seen somewhat of a tangent here, some really interesting ideas about how to eliminate inflation from long tail liabilities for insurers and do so in a way that doesn't completely disenfranchise your policyholders. But that's a whole nother podcast. So
Right.
we'll put that aside.
We'll come back.
So I think the answers in brief are, these inflation, these assets with positive betas to inflation that everybody's reading about and talking about, as well as on an enterprise basis, reducing your operating leverage until you've got it priced into your book.
Okay. Ready to talk about anything else on the asset side?
Absolutely. Fire away.
Okay. So you mentioned a couple of things there in passing. You mentioned some structured products. What's your view of those for the applicability to insurance assets?
I think that depending on what type and where they are, I do think that they make a lot of sense because the structuring itself enables reduction in risk while still retaining the exposure that you want in general terms and getting more favorable capital treatment. It does vary. I think structuring of equity type assets aren't as positively viewed as structuring of loan type assets. But that, despite that distinction, I do think that structured assets do have a very appropriate role in these portfolios in response to these conditions.
Is that structured credit, or does that also include, in your view, CMBS, RMBS, all of the ABSs, et cetera?
Yeah, all of the above. But I do think that the details are important. The manager is important. The structuring is important. So I just want to give that qualifier that while these are all things that deserve a first look, differentiation by those criteria is paramount.
Right. It's always due diligence.
Yeah, for sure.
So I'd like to shift this a little bit because one of the things I found is fascinating in our previous talk was we talked about this trend of insurance investors who had outsourced basically everything they could over the last couple of years and trends towards that. What are your thoughts on that trend?
This is something where I'm going to, through my comments, I'm going to reveal my age. I won't say specifically what it is, and I'll dispute any rumors that I talked to Thomas Edison about this, but I've been doing this for a long time. And I am just amazed how much we've changed, Rob. Mm-hmm. And by that, I mean from years ago, third-party managers actively avoiding insurance companies because it was viewed as just a hot mess. Mm-hmm. And insurers with business models designed to compete with those managers for assets of other investors to now insurers looking to outsource routinely, and we can speak specifically about that, and managers themselves who are sponsoring the formation of insurance companies in order to have more insurance AUM. So I just think that it's dramatic how much we've changed. And I think about this outsourcing in three areas. The first is, I'll call it decision authority, or formerly known as the front office. I think I call this the skill-dependent part of it. Okay. And we've all seen the recent trends, but I'll mention them in the interest of completion. In the U.S., it's been broad spectrum debt placements, private equity, private debt. In the UK and Europe and APAC, it's been more public equities and specialized fixed income, I'll call it, with some more recent spikes in alternatives. And in so-called offshore, it's been these, as I referred to earlier, these broad spectrum fixed income mandates. And I hope we come back to that in particular when we discuss active management later.
Okay.
But that's the first area. The second area, I think, is especially exciting, which is the new quant and data science tools that inform these decisions, these skill decisions, in ways that were not available previously. And then the third area which I think is the low-hanging fruit, is operations in all respects, reporting, compliance, trading. These are things that need to get done for efficiency savings. Mm-hmm. The two big questions that I have in this broad trend are as follows. Should an insurance company outsource completely its investment function, the so-called OCIO?
Right.
On this question, I'll give my answer.
Please.
On the second one, I don't have an answer.
Okay.
And I would say that with all but a few exceptions, those being smaller, less complex insurance companies, an insurance company should always have an experienced, bona fide insurance investment professional in the house.
Okay.
And the reason for this, at least that one person, is because there are just so many other dimensions to managing the balance sheet that those formal and informal interactions as a part of the senior management team, day-to-day, ongoing basis, will yield significant benefits, especially given the leverage of a properly designed investment portfolio, that you will forego if you completely have it outsourced entirely. That's my personal view.
Okay.
Despite great outside managers who take over OCIO, I know them, they're qualified, but it's episodic. Mm-hmm. So the dynamic. The second question is bundling these three areas, mm-hmm. Whether you should bundle the mandate with the quant modeling, or with the operations systems that are now being offered. So that's, I think, a really important question to any insurer that's going to outsource. How and where you bundle, that gets into it's very idiosyncratic for each company. It gets into fee negotiations. Mm-hmm. Those are my two big questions. Should you outsource everything? And how do you bundle?
So, it's my perception that one of the things that makes answering either of those questions very difficult for the recent past is most of them really only started in the last couple of years during exceptionally low interest rate and very, very high equity returns markets. So it's essentially harder to see what goes wrong. Do you think that's fair?
Well, I actually think that outsourcing started to occur, I don't know, the data would tell us exactly, when insurers wanted to go into more specialized, I'll call them fixed income mandates that weren't common with their in-house staff.
Right.
And that basically gained momentum. It then migrated to private equity, yep. And then structured areas. But it's been happening for more than a few years, but I think it's been a progressive spectrum of outsourcing mandates. What is more recent because they have been developed more recently, are these quant tools, data science, and the operations efficiencies. They are a last couple of year kind of outsourcing option.
Okay. So amidst all of these questions, whither tactical asset allocation?
Well, I would say that, let me first say that, give some editorializing on the public markets.
Yes, please. This is a podcast. That's what it's about.
Yeah, absolutely. So with all this understandable rush to private markets, and I understand that, to capture with low rates, where do you go? And also gaining almost a scary momentum from the great returns that have occurred in the private markets. The public markets, I think, have been underestimated into how they can contribute. These woeful second-class, kind of like public classic sleeves, I think, are being really underestimated in how they can still add to an insurance company. And I think that there are two areas, one of which you've mentioned, but first, let me say what's happened in the market conditions that create this opportunity for insurance companies. That the movement to private markets has contributed to volatility in the public sector. There's less trading depth. As we all know, there was a legislated reduction in prop trading by the street. Mm-hmm. market making. And I think the behavioral elements today are exaggerating market swings. So this has created dispersion in returns, dynamic correlations, all the things that are a tactical portfolio manager's dream.
Right.
So I think that they need to be captured, and to some extent they are. So we mentioned earlier these broad fixed income mandates where a manager is given multiple sleeves to tactically move between them, as opposed to parsing it, so to speak, and having it decided by an investment committee meeting episodically. It just, this kind of like one manager broad mandate, I think, who's doing it for a living every day, makes a lot of sense. It does create some challenges on benchmarking and performance attribution, but that notwithstanding, I do think it's a good idea. You're also seeing it, I would hope, in hedge funds allocations, because I do think that this is this tactical kind of, it's not only TAA, but more different particular types of hedge funds. And I think it's promoting the growth along with some regulatory improvements in the use of ETFs by insurers, especially in the fixed income side.
Okay.
The other aspect, the second broad category related to the public markets that I think needs to be looked at is this one this paper that I, with my co-authors, wrote some time ago on actively customizing. I do think that more attention to this dormant area. It's more passive. It's more kind of assumptions that get skipped over pretty quickly, has enormous potential in the form of carefully prioritizing how you customize and then pricing it in the market today, the cost of customization, given current expectations that your firm has for investment returns.
Okay, well, could you give us a thumbnail on what active customization is, where the rubber hits the road? How would this type of thing be implemented? And by the way, if anyone missed any of this, Bill's paper is on our website for this episode in the episode assets.
Yeah, so I'll get, with that in mind, I'll give a very distilled version of it, and that is that the first thing I think that companies need to do is they need to prioritize what their customization needs are and establish thresholds which can't be violated.
Okay.
And by customization, this is a nice way of saying constraints.
Okay.
But minimum capital, maximum risk taking in ALM, minimum liquidity, so concentration limits. So they need to establish those boundaries, but they also need to establish which are more important than others.
Okay.
And that's the first step. And then the second step is, and there's ways that can be done in a more than just kind of blunt force. So like, rank ordering. And these are discussed in the paper. And then the second area is, with the benefit of what we call a third parameter, an index of customization, view this in the context of risk and return. So there's now three parameters. There's customization, there's risk, and there's return. And there are ways to compare these in different environments. So you can dial up the customization if it looks like the opportunity cost of return is not great, or the risk reduction benefits are substantial, or you can dial it down within limits to say, this is a moment where I'm going to give up a little bit of customization to capture much more return or much better risk-adjusted returns. So it's a much more active process. And I think that this is one that hasn't gotten the attention that it deserves.
Interesting. Yeah. Well, so as I said, it's the paper is there if you all would like to read it. So, well, thank you, Bill. This has been a great thumbnail of all these things, and it's really interesting to hear your thoughts on the trends in the outsourcing.
Happy to do it, Rob, and I appreciate being invited. And good luck to you and your team.
Thanks. We'll have you back soon. Our next episode, for those viewers subscribed to our podcast, is on trade finance, and it will be with a former speaker who spoke on a webinar here last year, Francisco Filia. Until next time, I'm Rob Rowan, and this has been Compound Insights.